If you'll loan us 30 minutes, you can trust we've got a guest that you can bank on. Who is he? You'll meet him coming up next on Carolina People. Good morning. Welcome to Carolina People. This morning we're at 1550 Oak Street, the Myrtle Beach branch of South Carolina Bank and Trust. We're focused on community banking, and we're visiting with the regional president and this week's host of South Carolina Bank and Trust, Tommy Bouchette.
Thank you for having me, Greg.
Good morning, Tommy. How exciting. A lot going on. Of course, this new branch. You all moved in. It looks like the sign says May 3rd.
That's correct. That's correct. We were real excited to be able to acquire this facility and open up last May. It's been good for us.
It's gorgeous. It is amazing. Yesterday we were here filming with Charles Miles, talking about planning funerals. It's fascinating just checking out the facility. It seems to go on and on. That the teller back there just seems so far away from the front desk. I mean, it's a great facility. Yeah,
we're very proud of it, and we've had a good response. So it's been a good move for us.
I bet. How long has South Carolina Bank and Trust been here in the area? What's a little bit behind the bank there?
South Carolina Bank and Trust was originally First National Orangeburg out of Orangeburg, South Carolina. The institution is about 60 years old. But about 5 years ago, a decision was made to become a statewide bank and moved our corporate headquarters to Columbia. And as you would be aware, Sun Bank, which is a bank that a group of local business people, with myself included, founded in 2001, sold to South Carolina Bank and Trust, and that's how they got into the market. I stayed on as the regional president.
Right.
So we have an office in Georgetown. Our home office is in Murrells Inlet, and of course now Myrtle Beach.
Just Myrtle Beach, absolutely. Well, a lot going on, and of course to see some of the folks that were here in the office yesterday, seeing the city executive, Eric Keys, and some other folks here in the office, they were really excited about the future with SCBT.
It's a great company, and I'm proud to work for them. Really.
Absolutely. Tommy, we think so oftentimes, and obviously later in the week, Randy Wallace will be with us talking about real estate. Harry Pavlak will be with us on Friday talking about Save Our Cats. And, of course, those men involved oftentimes with banking and obviously the real estate industry. A lot has to happen with banking. But when we think about banks, just a little bit about so viewers would understand how exactly, I know it seems a very basic question, but how do banks work?
Well, Greg, it's really kind of a simple business. We essentially ask people to bring money to us, and we hold those funds in safekeeping, and we give them interest on their money, or we provide a service for them in the way of an operating checking account, so they can facilitate money from one place to another. In return, we lend money out, and it's very much akin to buying something at a wholesale price and then retailing it. Somebody comes in for a car loan, we retail a loan. So we take those dollars that come in through the front door and we lend them out, on the side door, and we make a spread. And in our business, a net margin is very small. We don't have very much room. Our net margin might be 3.5% to 4% a lot of times on our loan portfolio. So you can't afford to take too much risk because you have one bad loan, it tears that net margin up. But it's all about buying money and then turning around and selling it for the most part.
And really monitoring risk closely.
One of the things now that's happening more so than ever before with what's going on in our economy, particularly as it relates to mortgages and housing bubble burst or whatever you want to call it, this whole idea of managing risk, that's really what most bankers do. Is every day they try to figure out, if I invest $1 million in this loan facility, what is the risk associated with it, and can I get paid a fair premium to lend that money out and absorb some of the risk associated with it?
Right. Yeah. Real quick about yourself, Tom. You've been in the banking business a good while. I saw reading about you almost 20 years.
Yep. Prior to that, I was in the retail business, and I'm a native of this area, so been kind of involved in the real estate industry prior to getting in banking, so real familiar with our area. I think that's important as well.
Yes. When you say from the area, you actually grew up very close by.
Just outside Georgetown, a little community outside Andrews, actually.
Right. Absolutely. So you do know this area. I think I saw you came over here in the mid-'90s.
I was with Wachovia Bank.
Myrtle Beach.
Transferred Wachovia Bank to Myrtle Beach in 1995.
Right. So you have been following the banking. You've probably seen some of the highs and some of the lows over the last 20-some years.
Yeah. It goes back even farther than that. I used to be with an organization called the Federal Land Bank, and agribusiness went through a terrible cycle in the late 80s. And that was, being a young man just starting in banking and lending primarily with the land bank, I saw real estate drop in value 30, 40, 50% over a 2 or 3 year period. And, people forget very quickly how things are, and cycles come and go. And, as far as you want to go back in history, there's been real estate cycles where people have, made a lot of money in real estate and then they've had bust and then they come back up again. So we're going through a cycle now, and we'll get through it, but it is an interesting time.
Recently, we've heard a lot about this phrase subprime, Tommy. Share with viewers exactly what that's referring to when they talk about subprime loans.
Well, a lot of folks kind of relate that to prime rate, the prime interest rate, which is totally different.
Okay, good.
But the prime interest rate is just the best rate that the largest banks in the country lend to their best borrowers. So they use that as an index. Now, in mortgages, residential mortgages, when you're talking about subprime, you're talking about a loan that is less than highest quality. In other words, it's a mortgage that may have some imperfections or some weaknesses in it. For example,
it has nothing to do with the prime rate.
No, nothing to do with prime
good.
rate.
That's good to know. I bet a lot of folks get that confused.
What it is less than a prime quality asset.
Right.
Now, sometimes those imperfections are very minor, has very little impact on the mortgage, but there's something about that particular mortgage loan that is a little weaker than what it normally would be. It may be a case of where the guy or lady has a very high loan or debt-to-income ratio, and because of that, they can charge a little higher rate. So back 2 or 3 or 4 years ago, when real estate was going so strong, and it just seemed like there was no end to the increase in the value of real estate, investor pools that buys these mortgages on what we call the secondary market would go in, and if they could get a little higher yield on what they were buying, they would take a little more risk. Well, as long as real estate values was going up and the market was great, then they looked like heroes, these fund managers that was buying that kind of mortgage paper. Now, unfortunately, when that bubble burst, or at least when the correction happened, it created an environment then where people started saying, you know what, I'm upside down on my mortgage, I owe more than what it's worth, I'm just going to give it back to the lender. And as a result of that, all these loans that had those weaknesses was the first one to start to default.
Right.
So that's where the subprime idea comes in. The conception or misconception is that, banks hold a lot of subprime paper. Well, some of your larger, like a Citi, or maybe even a Bear Stearns, a Goldman Sachs, those type of financial institutions, they would buy billions of dollars of mortgage paper, and they sell them in securities or sell them off as securities. Well, what happens at that point is they get stuck whenever people quit buying them, so they have to hold them in their books. And that's whenever you first started seeing the breakdown, if you will, in subprime paper.
So we're really seeing those issues not necessarily with banks here locally, but with very large multinational banks, maybe even ones based in New York or otherwise.
Correct, because what happens, the average bank in our community or in our state, or across the country for that matter, the average bank does not hold 30-year fixed-rate mortgages. They're originated to be sold into investment pools as securities. So when you come into the bank, your bank may originate that 30-year mortgage fixed rate, but it's sold off pretty much right at closing or shortly thereafter.
Right? Almost always locally. So even though our relationship may be with Tommy Bouchette or with another banker up and down the Strand or in the PD or southeastern North Carolina, that you or whomever is not going to have much control of that loan later on?
That's right, because it's a 30-year fixed, and we disclose that up front. If you came in, we would say, now, Greg, this is a 30-year fixed rate product. In order to get you a 5 3/4 or 6% 30-year fixed rate mortgage, we'll have to sell this off into what we call the secondary market. So you're told that up front. And then, of course, that mortgage gets sold off, and some of the larger banks will continue to service those loans. They have what's called a servicing agreement with the investor pools. And then what they'll do is you may even get statements and everything from whatever bank. But in reality, that bank doesn't hold that paper. So for banks our size, and we're about $2.6 billion in assets today.
That's big.
Pretty good size. And we don't hold any of that subprime paper. When we were doing that, when the market had a product available for it, we would originate it for those investor pools and then sell it off. So we really don't have that kind of subprime exposure, and most banks don't. Most
Right.
smaller banks anyway.
That's fascinating, Tommy. That's something that a lot of people may not know. I'm glad you
Right.
said, as you say, you highlight that up front. You make sure and let people know. What about local real estate conditions? Of course, again, Randy Wallace will be with us later this week on Thursday to talk about some local real estate market trends. And obviously, this is a non-commercial show, but at the same time, it's interesting just to think about local real estate conditions. Let's say here along the Grand Strand.
Well, as a lender in this marketplace, you have to do real estate lending. You have to do construction and acquisition and development type loans because that is our industry. I mean, we're not in Greenville where we have very much manufacturing sector. So as a result of that, we're involved in it every day. We finance a lot of construction projects, a lot of development loans, and no question about it, there's been a tremendous slowdown. But we've been real fortunate. We've got good operators. We've got guys that's been in this business for a long time, and they've seen the cycles, and they could kind of see this one coming, and they put back a little cash, and they cut back. So overall, I think most developers are still in pretty good shape. However, I will tell you that we've seen some deterioration in values. We're not where we were a year or two ago, and by definition, a correction, which is what most of the experts would tell you, that's what we're experiencing, is a correction in the real estate, just like the stock market goes through these correction periods. That's to be expected.
Right.
So, but the good news is, we still have these baby boomers coming down, and they're retiring, and they're going to find a place. And if we can ever see some improvement in the northeastern market, then I really think that we'll be in great shape again. But
there's some good buy opportunities
there.
here.
Wonderful buying opportunities for people.
Right, surely. And there'll be people continuing to come to the Myrtle Beach area.
That's right.
Horry County is going to continue to grow. Obviously, the opportunity of the U.S. Interstate 73, I-73 terminating in the Myrtle Beach area is going to be a tremendous coup.
Well, again, I would say that in the market we're in, all things being equal, we are probably better positioned to weather this storm than a lot of markets. South Carolina as a state, the last report I saw, our foreclosure rate was just slightly above 2%.
2%,
yeah,
right.
Which is not not great news, but compared to other states, I mean, a lot of states are even double digits. The folks in Florida, for example, are really having a tough time.
Right.
Michigan is terrible. I mean, 12%. So we're going to stand this storm a lot better than the average market might be.
Speaking of standing the storm, a lot of folks think, should I be with banks, for instance? What's the difference of keeping my money at home? What is a bank going to do for me instead of me shoving it under my mattress? Coming in early this morning to be here with you, and thanks again for opening your home here for us to be here this week. But why should I put my money with a bank?
Greg, day in, day out, I truly believe that a bank is the most safest place in the world you can put your money.
Really?
Of course, you got FDIC coverage. Now, the Federal Deposit Insurance will only cover up to $100,000 per account. So theoretically, you could come in and have $100,000 in a CD, and you and your child or you and your mother or whoever could have another account set up. So there's ways to get more than $100,000 in coverage. But just having that protection, you can't guarantee $100,000 protection at your mattress.
Right.
And the other thing too is, banking today is so highly regulated. Now, even with all the regulatory oversight we have, that doesn't stop people from making mistakes, or that doesn't stop market conditions from deteriorating to a point where banks run into problems.
Right.
But overall, it is a very rare occurrence indeed to have a bank fail.